Hello, my name is Gary Yao, and today I would like to give you a little take on why I think the interest rate is not going to fall. So let's talk about interest rate. What moves rates? The number one factor that moves rate is inflation. Why? Because during the pandemic, in this short 2 years, we printed 1/3 of all the money in circulation since we started as a nation in 1776. Imagine that. For almost 250 years of history, we managed to print 1/3 of all the money that is in circulation in 2 years. The Fed purchases MBS or mortgage backed securities. Now the Fed is tapering. Is this concerning? Let's break it down on what is it that they spend each month. They spend $40 billion in new mortgage backed securities or MBS, $80 billion in treasures, $60 billion is invested in money, loans that are paid off. That is total $180 billion per month. The Fed has $8 trillion in money invested in mortgages, and they are not lowering that amount. So what is being taped in this is just part of the $40 billion, meaning that they will stop buying these securities, which will effectively raise rates. So what happens with the Federal Reserve raise rates? It tightens the credit, it slows down the economy. The goal is to bring down inflation. Let's look at history. In 1970s, Arthur Burns was the federal chairman. He ignored inflation, which rose rapidly. He insisted that inflation was transitory. Sounds familiar? Year over year, inflation ballooned from 7% in 1978 to 14% by the time he left in 1980. High inflation caused mortgage rates to rise from 12% to 18%. In 1980, Paul Volcker fights inflation. He hiked the Fed funds rates from 11% to 20% in 2 years. And you can compare that to today's 5%. Inflation dropped from 14% to below 5%. Because inflation dropped, mortgage rates rose sharply and declined from 18% towards 12%. But there were consequences. The S&P sharply declined by 30% during this time. Tightened monetary policy pushed the U.S. into recession in 1982. In the 1990s, Alan Greenspan, in the late 1990s, inflation doubled from 1.75 to 3.5. High inflation caused mortgage rates to rise from 7% to 8.5%. Unlike Burns, Greenspan took action in the mid-1990s and hiked the federal funds rate by 1.75%, matching the rise in inflation from 4.75 to 6.5 in 1 year. Inflation responded and dropped from 3.5 to 1%. Mortgage rates dropped from 8.5 to 5.5, sparkling a refi boom. But there were consequences. The S&P fell by 50% from the spring to the fall of 2000. The US entered a recession in 2001. Let's talk about today, currently with Jerome Powell as the Federal Reserve Chairman. In 2021, inflation increased from 1.75 to 7%. This inflation was considered transitory. High inflation rates caused mortgage rates to rise from 2.25 to 3.375. The Fed is currently tapering their purchases of mortgage bonds and treasuries. We will not hike and reduce purchases at the same time. The Fed was done tapering in March and began hiking rates in May. The Fed announced 3 rate hikes in 2022 and 3 more for 2023. The inflation and interest rates can still rise until the Fed acts. If the Fed can tame inflation, mortgage rates should drop, but may be from higher levels. So, do you see a pattern here? What's the forecast? Rates go up in the near term to 7% due to inflation and balance sheet runout. Recession will hit around November this year. Rates will drop to low 3% and high 2%. It will do a boost the demand in housing. The housing market will continue to be strong. And that is why I predict that interest rate will go down next year, will cause prices to continue to go higher the following year. My name is Gary Yao, and I will talk to you soon.